Jeff, always good having you, more so on the post-policy outcome days, as we made it a habit to talk to you. How did you see, let's start with the FOMC, right? How did you see the Fed commentary? To us, it looked like it was maybe a bit of a divided house with no clear direction, if you will.
I think it probably is a slightly more divided house. I found the whole thing actually a little bit dull in the sense that there were no fireworks, there was no rate cut. We weren't expecting a rate cut, of course. And I think the way the forecast went was pretty much as expected. So growth numbers down, inflation numbers up, and although I feel at the margin the economy is weak enough now and probably going weaker that we may not be very far from an interest rate cut. Obviously, the Fed wasn't ready to do that this time around, apart from anything else, it hadn't warned the markets about that. But at the end of the day, I think the two giant uncertainties are tariffs and, of course, the situation with the Iran-Israeli war and the impact that will have on oil prices, which are up nearly 10% over the last, I guess, 5 or 6 days now since the latest conflict began. And I think that's what's holding the Fed back at this point in time. And I think that's probably the right thing to do at this stage.
Hi, Jeff. Very good morning. I just want to get your view on the change in the inflation projection. 3% is where it stands right now for 2025. GDP projections are brought lower in the past, and I'm talking about several years. The Fed has not necessarily had the best track record predicting recessions. I'm just wondering if, with the downgrade in GDP, is that conservative at all? And is there going to be a bigger impact both on inflation on the upside because of these tariffs and the implications for the GDP?
I think the Fed probably believes the economy's okay. And I mean, Powell keeps saying that the economy's in a good place. I do think the risk of recession or a period of extremely slow growth has increased. But at the end of the day, I think that risk is not so high that it's forcing the Fed at this point to do what Trump wants them to do, which is to cut rates. And the reason for that is, of course, because the inflation story is somewhat troubling. Yes, we've had four, I think, monthly inflation forecasts that have been better than expected. But with the Fed's favored PCE inflation number now projected to be at 3% this year, up from 2.7% previously, moving away from the target. As I say, I think there's plenty of reason for the Fed to wait. Now, in the event that we get an even weaker economy, which I do think is a distinct possibility, the Fed will then have an even bigger challenge. Do they ignore some potential short-term impact on inflation from the tariffs and from the oil price and go to cut interest rates to support the economy? That's going to be the dilemma down the road, but we're not there yet. However, above all, this combination of forecast changes, growth down, inflation up, is unfortunately very stagflationary. And I think that was really what not really caught the markets out, but made the markets nervous, I think, equities nervous after the Fed's announcement. Particularly, they were concerned, I think, about the pickup in the inflation forecast to 3%.
Jeff, a very good morning to you. I mean, and I agree with you, a whole lot of nothing in that sense. Even the post-Fed meet Trump comments weren't as much as you expect, if that is one thing to watch out for. Having said that, just your view on the other big crisis brewing. Any sense you have of what exactly is going to be the U.S. involvement in the Iran-Israel conflict? Trump is talking about, an Iranian delegation coming in to meet him, but there's also reports that they're gearing up to really be a part of this in a big way. And if the United States comes in, this entire conflict takes a whole nother level.
Yes, it does. And I think it's just obviously so hard to predict that. I suspect that one of the reasons why the U.S. is talking about either helping Israel with the so-called bunker buster bombs or aircraft to carry them, alternatively the US getting directly involved, is because Israel has inflicted a lot of damage on Iran's nuclear capability. And maybe the US is thinking that if we get involved at this stage, or perhaps for a short period of time, we could finish the job, so to speak, and actually destroy the nuclear capability of Iran. I wonder if there's a sort of tipping point that they're nearly at. Now, I have no idea what's going to happen, obviously, but my suggest is that, my feeling is that there's no smoke without fire here, and that you've got to assume that the US may very well get involved, and for sure Israel's going to keep going this time until they have even more success, I think, trying to destroy this nuclear capability. As far as markets are concerned, as I wrote in a post I put up today, the one variable that is so important for economies, for markets, etc., that has moved a lot is, of course, the price of oil. Other variables have not moved. US equities are pretty flat since this all began. The EM is pretty flat. The dollar's pretty flat. So what we've got to watch here to see some further potential impact of this war on the financial markets, I should say, not just generally geopolitically, but on the markets, is going to, I think, be driven by what happens to the price of oil. And that we've got to watch very carefully, because the stronger the price of oil gets, the bigger the risk to these oil importing countries like India. It will impact the US economy, a lot of other economies, and therefore that becomes a real inflation threat. And I think that's going to be something we have to watch very carefully.